Amazon stock has seen a recent pullback of about over 10% decline in the stock. As we know, Amazon is one of the largest companies in the entire world, and while most of you will know Amazon for their packaging services and products, Amazon doesn't even make money on that service. However, Amazon makes their money from their software business called AWS. With the recent sell-off in the stock market and especially Amazon, I decided to make a video today to see what price we should pay for Amazon stock and also analyze the company using my 7-step stock analysis to determine the financial health of Amazon. The first metric that I'm going to look at for Amazon is the PE ratio. I want the PE ratio to be greater than 0, which means the company is profitable. And all the PE ratio is the share price divided by the earnings per share. So if the earnings per share is greater than 0, which means they make money, that means the PE ratio also must be greater than 0. And if we go ahead and look at Amazon, they have a trailing PE ratio of 38.76, which means they are profitable, and that is a check mark. However, I think the PE ratio is slightly higher than the S&P 500. Normally, the stock market runs at a PE ratio of about 20, so if it is over 20, that means it might be slightly overvalued unless it is a better company overall compared to the stock market. And the next thing that I'm going to look at is the forward PE ratio. The same thing as the trailing PE ratio of the price divided by earnings. It is the price of the stock divided by the future earnings expected by analysts instead of the earnings per share as of today. And I want this to be less than 30, showing that in the future analysts expect it to grow, and also if it's less than 30, that means it is probably undervalued. And as we can see here, they have a forward PE ratio of 32.57. So that is an X, however, it is not very far off from what we want it to be. Now I'm going to take a look at the revenue growth rate of Amazon. I want the revenue growth rate to be greater than 5%, which basically means their total sales each year is growing at greater than a 5% rate and shows that they're growing decently. As we can see in this chart, their revenue growth rate is increasing every single quarter by at least 10%. And as we can see, it has been slowing down the revenue growth, but it does make sense since they are having a revenue of over $600 billion. So it does make sense it is slowing down slightly, but it's still growing crazy fast, especially for the amount of money they are generating. So this is a check mark and is much greater than 5% and shows that the sales have been growing at a good amount. Now I want to take a look at the earnings per share, which is basically the net income divided by the shares. So I want this to also be increasing at a 5% rate, similar to the revenue growth, to show that their net income is growing over time. And as we can see here, they had very consistent growth until about 2022. They had a huge decline and had a negative earnings per share for one quarter. However, after that, they have been rapidly increasing their earnings per share by a crazy margin now. So this is also another check mark. However, I do not like how much it dipped during this time in 2022 and 2023, but it is overall increasing over time, so this is another check mark. Now I'm going to take a look at a very important metric that nobody even looks at, and this is the shares outstanding. We want the shares outstanding to be decreasing over time. If the shares outstanding decrease, that means the company is buying back their own shares, and this means that the shares that us investors hold will be worth more since there is less available for other investors to have. So we do not want this to be increasing, but we do want it to be decreasing. And as we can see here, Amazon has been increasing their shares pretty consistently. So this is an X and shows that they're diluting us shareholders. Meaning if we had a share and just held that share over time, it is going to be worth less of the company, a less percentage of the entire business. So this is an X. The next metric that I'm going to look at is the total debt divided by equity. I want this to be less than 50%, which means they have greater than double the amount of equity than debt. So as we can see with Amazon, they have a 54.34% total debt to equity ratio, which is slightly higher than what we want, but it is not a very big deal since it's basically right there. But nonetheless, it's still an X, and they do have less than double the amount of equity compared to debt. The final step for my 7-step stock analysis is the EPS growth expected by analysts. I want this to be greater than 5%, showing that analysts have confidence that the company will grow in the future. And as we can see with Amazon, they have a very high EPS growth rate for the next 5 years expected. They have a 22.9% rate. This is very high, and if they can achieve this, especially at the size of the company, that would be incredible. So that is a check mark. Finally, I'm going to use an intrinsic value calculator to determine what price we should pay for Amazon stock. In order to use this intrinsic value calculator, you have to use assumptions for the next 10 years. And the first assumption we have to make is the revenue growth rate. I'm going to put the revenue growth rate for Amazon in the next 10 years at 10%. Analysts expect them to grow at about 11 to 12% revenue growth rate in the next 5 years. And as we can see, they've been around this mark for the past few years, so I think they can sustain a 10% revenue growth rate. Now for the net profit margin. As we can see here with the net profit margin, it has been increasing basically every year, from 4% in the past 10 years all the way to 9% this year. So I think they're going to increase this even more because of their AWS service. As they scale that more, they're going to make even more profit. So I'm going to put the net profit margin at 12%. Even though they've never hit that yet, I do think they can get up to that. Now for the cash conversion rate, we can leave at 100%. And then the terminal PE ratio in the next 10 years. I'm going to put this at a 23. The reason I'm going to put this at 23 is because I think Amazon is growing faster than the total stock market. And since the S&P 500 is a terminal PE ratio of 20, I think they deserve the slight premium for the stock. So I'm going to put this at 23. Now for the discount rate, I have changed this and I'm going to put it at 15%. In the past videos, I've been having it at 12%, but I want a greater margin of safety, especially since we're buying individual companies. If we didn't want to have any risk, we could just invest in the S&P 500 and get about 9 to 10%. But we do have a lot of risk buying one individual company, so I'm going to put a discount rate of 15%. And as we can see here, I have a fair value for Amazon stock at about $161.57 per share. If you bought this today, you'd probably make about 11.2% if you believe these assumptions. But if it gets down to about $160, I think you can make about 15% year over year. So this is where I'm going to buy Amazon if it ever gets to $160, and then dollar cost average if it goes down more. So this is my target for Amazon at $160, and I'm definitely going to buy some. So thank you guys for watching this video. Comment down below what stocks you want me to cover next. Please subscribe, hit the like button. See ya.